Good day, welcome to the PSG Wealth Local Solutions Performance Overview for March 2019. The local market ended March in the green with the FTSE JSE All Share Index rising 1.6% for the month, boosted by strong performances by resource and industrial counters on the JSE. The top performing asset class in Rand was offshore property, returning 7.6% for the month. The Rand weakened by about 4.4% versus the US dollar, causing the higher returns of offshore assets in Rand terms, as the graph illustrates. The solutions delivered performance that was largely on par with that of their respective benchmarks in March. Year to date, until 12th of April 2019, all of the local solutions have outperformed their benchmarks. Over the minimum investment horizons, the funds have continued to deliver strong performances. Looking at some of the highlights of the funds, PSG Asset Management has 3 funds that are currently on the quantitative radar screen. Overall, only 3 out of the 25 funds on the local side are on the quantitative radar screen. They remain one of the strongest fund managers, but all managers go through periods of underperformance when their investment style goes out of favor over short-term periods. Long-term, we still believe that PSG Asset Management will continue to add significant value to the overall fund of funds, as they have done in the past. This month, we'd like to highlight why we believe that growth periods may be misleading, especially for clients that aren't informed on this topic. A growth period has a single start date and single end date. This can often understate the consistent performance of good quality managers or vice versa. These 2 tables illustrate why we believe growth periods returns may be misleading. Funds A and B are 2 funds that we use in the PSG Wealth Creative Fund of Funds. At the end of November 2018, Fund A was clearly one of the best performers in the peer group, while Fund B's performance looked terrible. Fast forward 4 months until the end of March 2019 and the tables are almost completely turned. Now Fund B looks like a superstar fund, while Fund A's performance looks terrible. It even appears that Fund A has underperformed over the last 2 years, while in fact it has only had 4 months of poor performance, and in the big picture 4 months is an extremely short term for an equity mandate. This slide illustrates why we prefer rolling returns. It uses the same 2 funds from the previous slide. It indicates a few important points. First, it shows that styles can underperform, often by quite a lot over the short term. It is then that perhaps the most discipline is required not to sell at a low, especially if short-term underperformance is the only concern. Second, we can see that even with short-term underperformance, we should invest over the appropriate investment horizon, such as 5 years for equity funds. The 5-year graph shows that even though the managers may underperform from time to time, the long-term performance has been substantially above the peer group average over the long term. That is all for this month. Thank you for joining me.